This paper is forthcoming in the Journal of Finance. And so as a discussant, how does that make me feel? Impotent. I mean, emasculated. Now, you know, there actually is a policy thing. Maybe you guys have talked about this, about whether such mature papers should be, you know, on the program. And I think there's a reasonable argument for why you might want to do it, because it's so hard to read enough these days, you know, even a forthcoming paper, getting it out in front of people and making people familiar with it is worth something. But, and, you know, I had seen the paper before, I think at the NBER, but I'm a lot more familiar with it now. But, you know, still, what's a discussant to do? The footnote thanks 14 colleagues for comments. The paper has been to 19 seminars and conferences, 2 anonymous referees. What's a discussant to do? Well, I thought of 2 things. The first thing is, find the fatal flaw. Tell Ken. Now, maybe this was accepted under Cam Harvey. Call Cam. Have the paper jerked on an emergency basis. I couldn't do that. Sorry, guys. Didn't find the fatal flaw. So all I can do is interpret it a little bit and discuss future work. So that's what I'm going to do. Now, you know, the paper is really well written. The results seem, as you saw, very strong and very interesting. The empirical asset pricing is, you know, conducted state-of-the-art. Very, even Cochrane-esque, I would say. You know, you saw the graphs, you even influenced the notation, I think. These guys obviously studied that stuff, and then Llewellyn, Shanken, and subsequent work very carefully. Thorough, 13 tables in the paper. Tyler sent me an appendix with 4 more. So, okay, a couple of things. Robert Novimarks is not here, but he'd tell you the story of how we learned that these kinds of papers where you're trying to find a risk factor to price things can be really sensitive if there's any sort of look-ahead bias in it or problem with it. Now, you know, given how careful these guys are, I have to assume that this is okay, but this is from Table 2, end of quarter 2010 data, not released until March. So that caught my eye, and I couldn't find anywhere in the paper where the exact dating of how the data was done was explained. So maybe you can respond, and you know, maybe that's, if you haven't done the galleys yet, you could be more specific about that so people like me wouldn't worry about it. Now, these simulations, I don't think I really needed these simulations of the random leverage factor, to be honest. You know, I can imagine that those were the result of some referee saying in the back of his head, you know, these results just look too good to be true, but I can't figure out what's wrong with them, so maybe if they do these simulations, you know, I don't know if that's what happened, but I can imagine that. Well, if you're going to do them, then it seemed to me that as far as I saw the way they were described, it didn't seem like the simulations were capturing randomness in the test assets, but only in the factor. And that, there's a lot of randomness in the test assets too. So that could make a difference. All those 0 probabilities, I'm not sure. And the other thing is what if you what if you thought about grabbing a random factor or asset? You know, this is from their Table 2, and it's interesting to me, you know, they're using assets minus liabilities. And if you look on the assets for these broker-dealers, about half of it is in this miscellaneous asset class, this mysterious class, And so this is a future research thing. That's all I can do is discuss it now anyway, right? Is, what is really driving this leverage, this asset to equity thing? Are some of these assets really important compared to others? There might be more to do. So I want to interpret a bit, and the two big sort of motivating questions are why intermediaries, and then why their leverage. And maybe you caught it in Tyler's presentation. The paper gives two answers to that. Why? And the first one is because the intermediaries are capital constrained. That's the Brunnermeyer and Peterson. And the second answer is because the intermediaries can trade in all these assets and they're unconstrained. He and Krishnamurti, for example. So, that seemed interesting to me, and I spent quite a bit of time. I know nothing about this intermediary stuff, so I spent quite a bit of time puzzling over this. The first example of the constrained intermediary case, Brunnermeyer and Peterson. Wow, that's a really insightful paper. Really enjoyed that. Just briefly here, the symbology is all distorted. The little fees have become W's with boxes around them. Anyway, so just briefly, in that model, you've got a risk-neutral intermediary who shorts or longs a number of shares in different securities, gets a payoff, expected payoff, that is basically the expected value less the price, okay, which is a price impact, right? So the price is below value, they go long, conversely short, and they're providing liquidity. All right, so they've solved this little problem, and you see they have this wealth constraint, this capital constraint, where they have to put margin up for each of their positions, and the amount of margin, whether it's a long or a short, multiplied by the number of shares taken across the positions, is their wealth constraint. So you set that problem up, and you put a multiplier on it, and you do your complementary slackness conditions, and you find that so when we're constrained, then phi essentially captures a ratio of the payoff to the amount that you have to put up in margin. And when the fee is zero, the constraint's not binding, and then there's no price impact, and so there's perfect liquidity. And that's kind of how that works. So this fee that they're thinking of is what they're trying to proxy for here is the aggregate marginal dollar payoff per unit of margin required. And so here we're using assets to equity of the broker-dealer. So, it just made me think for future work, how about some other things? I thought about, how about changes in bank capital or leverage? I'm thinking of Basel value at risk rules for bank capital that really, when things are crazy, the capital constraints get more stringent, which kind of works in the right direction for the story here. They say at one point in the paper that a portfolio of financial stocks doesn't work very well as a factor, but it's not quite the same thing. I do note that if some data from he and Krishnamurti, that the broker-dealer sector equity to assets in 2007 at least is about the lowest of all the industries they looked at. So it's about 4%, whereas in the banking sector it was about 12%. So there may not be as much crazy action in the banking as there is in the broker-dealer. Liquidity, this really is kind of a liquidity risk story, so it made me think about what about other measures of liquidity. They say that their measure has very little correlation with the Pastor-Stambaugh kind of measure, and it is a price impact in this model, but the Pastor-Stambaugh is kind of this reversion of price impact. Maybe it's not exactly the kind of thing you have in mind, but maybe there'd be some other liquidity measures. Now the other answer is that we do the intermediaries because they're unconstrained. Now it's clear in the paper that the favorite one is the previous one. But this one's also used. So in here, it's the households that are constrained because they can only buy from intermediaries, the risky asset. And then the intermediaries, by assumption, have to have some skin in the game, and that's this M. So the amount of intermediary services that household can buy is constrained to be below M over W, where W is the intermediary capital. But the intermediaries themselves in this model are unconstrained. They can borrow or lend as much as they want. They take a position in the single risky asset. So here's a simple equation for a position in the single risky asset in a Merton-style model with no sort of hedging. It's one risky asset. And so you think of that X as the portfolio weight. You know, this is how you teach maybe, and you draw the frontier, you draw the line, you know, and you'd say, okay, when you're right at this dot, the X is 1, you're holding the market, there's no leverage. Assets over equity is equal to 1. If you go out on the line, you're taking on leverage. Assets over equity is greater than 1, you know, and so on. So there it is. And so in this view of it, they're using assets over equity as the measure of leverage, and the X is a measure of leverage. So, all right, now what you want in this model is to price returns is the covariance of returns with the marginal utility of wealth, J sub W. Instead, we're going to use assets to equity. Now, I can just take the log on this and look at the difference. Oh, it changed my size of the thing. So what used to be on the right-hand side at the bottom, the marginal utility of wealth is the thing you want, according to this view of it. And then on the left-hand side is the thing that they use. And you see that there are a couple of things in between what they want and what they use, according to this view. And one of these is the reward to variability ratio in the middle there. And I did a back of the envelope from the paper as best I could that the volatility on a monthly basis of the assets to equity thing is about 6 to 8%. And then I found this, I was citing Robert Whitelaw below there, but it got cut off for ex ante Sharpe ratios about 0.25%. So, gee, that's a big thing that gets in between what you sort of want in this view and what you're using. And indeed, Brennan, Wang, and Xia use the Sharpe ratio, at least, as a risk factor, together with an interest rate factor, and found that it worked really well. So that's kind of interesting to me. I mean, it kind of suggests the possibility. What if you use the leverage and the Sharpe ratio, could you have the penultimate two-factor model? Could you kill the French and Fama factors once and for all? That would be pretty cool, right? So now another weird thing about this is that the equity is the same as the wealth, and so the red E cancels out of this thing, and it leaves you with assets being the driving factor. They had a correlation 0.73 between the assets and the leverage. It has the assets as the driving factor. Now, I don't know about this second derivative of the utility function with a quadratic approximation. Maybe that doesn't have much volatility. I don't know. So that's pretty much what I've got to say. There's just one little thing for exposition. If you haven't done the galleys yet, is it says somewhere in the paper something like, according to the logic of the APT, the sign of the premium should be positive. And at least the APT that I remember doesn't tell you about the signs of the premiums. It just says there exists some premiums such that expected returns are approximately spanned. So, okay, thanks.